the conference. So ladies and gentlemen, please put your hands together and can we have a thunderous round of applause to please help me welcome on stage none other than Mr. Ananta Barua.
Good evening, everyone. I hope everybody is active in this passive conference. And I don't want to speak too much. I just wanted to give some perspective. Actually, recently SEBI had set up some committee. So the report has just been received. So I can't reveal much, but still I'll share something. As you know, India was soon after we allowed derivatives. Actually, earlier, derivatives was banned, and then subsequently law was changed. And first time derivative was allowed in 2000 when the derivatives on indices and on stock futures were allowed. And we saw the first ETF in 2001 based on Nifty benchmark ETF. And then there was a debt ETF in 2004 by name of Liquid Bees. And incidentally, both were launched by Benchmark Mutual Fund. And then for the first time, gold ETF was launched in 2007. Actually, this was an innovative product, unique in the world, the first time that gold ETF was launched. And if you read, there was a report to making Mumbai the international center. There is a talk of this, there was some delay and whatever is there. So that is an innovative product which was launched. Then after that, we saw in 2013, then ETF was recognized as an eligible asset class for the pension funds. The pension funds, first time, they were not allowed to invest in stocks. They have been investing in G-Secs and all. The first time they were allowed to invest through this class, pension funds, through ETF. Then additionally, securities transaction tax were lowered to make ETF at the level playing field with other mutual fund schemes. Then in 2014, with the government efforts to divest its shares in public sector enterprises via the ETF route, led to introduction of CPSE ETF. Even this was an innovative product. First time in the world, the ETF was used for disinvestment. And but after that, we saw that the growth of ETF was not that happy one. It was slow. And in 2015, with an AUM of 8,060 crore, the AUM started picking up. After that, some of the key drivers were there was some awareness of the passive investment, then inability of majority of active large cap funds to outperform the indices, and low fund management fee. The other key factor which helped the growth of ETF. There are some data is there, I think you may be aware of. Still, I will say, to progress to the next chapter, why we want to encourage this segment. The total AUM of the Indian passive ETF industry is 5 lakh crore as on 31st March 2022. CAGR of 57% over the last 5 years, and growth of 61% in financial year 22. The passive investment shares in overall mutual funds AUM has increased from 3.8% in March 2018 to 13.4% in March 2022. Globally, the market share of ETF as a percentage of mutual fund industry is 14.1%. Today, we have 228 passive products in the country. And we have ETF equity 104, debt 17, 121, index fund 71, and debt 22, total 93, and gold ETF 14. And we have seen, actually earlier it was mostly driven by EPFO's contributions to the ETF inflows. But recently we have seen there is a lot of interest from the retail investors. And non-EPFO growth is driven mainly by corporates and retail HNIs. Retail and HNIs account for about 7% of the total AUM. 1.6 crore new folios were created for ETFs index fund in the financial year 2002. 60% of the outstanding folios of 1.75 crores as on 31st March 2022. Retail and HNIs account for 99% of the folios of 1.75 crores, which implies that increasing retail investors are investing in passive industry. I will go into the existing some framework which were provided for equity ETF and debt equity ETF. Some requirements are there. As per the regulatory norms, the index shall have a minimum 10 stocks as its constituents. For a sector thematic index, no single stock shall have more than 35% weightage in the index. For other than sectoral or thematic indices, no single stock shall have more than 25% of weight in the index. The weightages of the top 3 constituents of the index cumulatively shall not be more than 65% of the index. The individual constituent of the index shall have trading frequency greater than or equal to 80% and an average impact cost of 1% or less over previous 6 months. As far as the debt, ETF, and index funds, the constituents of the index shall be aggregated at the issuer level. The index shall have a minimum 8 issuers. No single issuer shall have more than 15% weight in the index. The rating of the constituent of the index shall be investment grade. The constituents of the index shall have a defined credit rating and defined maturity as specified in the index methodology. The debt ETF index fund shall replicate the index completely, but there are some exceptions are there where the complete replication is not there. Some waterfall mechanism has been specified, so that I don't want to go through. And all you know this advantage of this ETF. And as far as the cost is concerned, and performance, there is some figures are there. And one of the advantage of passive funds are also known for low portfolio churning. The change in compositions of securities mostly happens only at the time of rebalancing of indices. Low churning helps to decrease volatility and transaction costs for schemes. S&P indices versus active funds, SPIVA, India scoreboard published by S&P Global for the year 2021, compares the performance of actively managed Indian mutual funds with their respective benchmark indices over 1 to 5 and 10-year investment horizons. Scoreboard highlights the importance of passive funds over actively managed funds. As per the scoreboard, during 6 months ending 2021, more than one half of the active funds in the large cap category underperformed the S&P BSE 100 index. Active index in ELSS and mid-small cap categories fared better than with 39.02% and 37.25% of the active funds underperforming their respective benchmarks. On 10-year absolute return basis, 65% of the large cap funds underperformed S&P BSE 100, more than 55% ELSS, and mid-small cap active funds underperformed to S&P BSE 200 and S&P BSE 400 indices respectively. This shows how passive funds would be a fair investment options for long term in terms of both lower cost and better returns. However, we have seen that the Nifty 50, Sensex, and Nifty Bharat Bond Index series account for 71% of AUM of ETF index funds. The average trading volumes of ETFs at NSEs have increased to rupees 352 crores per day from rupees 207 crores per day, while the trading volumes has been increasing but still continues to be low. And one of the challenges is the low trading volumes. And AUM is concentrated in few indices. And to develop this one, SEBI recently constituted a working group to study various aspects of passive funds in India. And this group was constituted with various stakeholders from the representations from the AMCs, mutual fund trustees, stockbrokers, market makers, stock exchanges, clearing corporations, and industry experts. And one of the suggestions is to encourage more investment indices, especially in the debt. And they've advised there should be three constituents. One is corporate bond indices. Second one is GSEC and Treasury and with SDL. And third one is with the hybrid of the two. And some of the things which the industry participants which brought to the table and which was hotly debated are, which I will going to read. The existing provisions regarding debt ETF index funds are also under review. As highlighted by the industry, difficulties faced by fund manager to replicate debt indices due to illiquidity in the corporate bond markets in India. Non-availability of the same bonds as that of indices makes it difficult to track their benchmark indices. In order to address all these difficulties, focus is to provide greater flexibility to the fund managers to replicate the underlying debt indices inter alia with the following broad principles. Duration of the portfolio should be similar to the durations of the index. Mix of rating weightage in the portfolio should be similar to that of the index. Positioning of the portfolio in the potential risk class cell should be the same that of the index. The single issuer, sector, and group limits may be complied with. The tracking error and tracking difference. In order to reduce volatility and difference of returns of ETF index funds with respect to its benchmark, tracking error and tracking difference are being suggested. Tracking error is calculated to compare volatility of returns of ETF index funds with respect to their benchmark. Tracking error is tracking difference calculates the difference in performance between the index or goods and the NAV of the ETF index fund. The tracking error and track difference helps investors filter ETF index funds which are volatile to index and has consistent returns as to the index. They have suggested some percentages like it should not exceed some percentage. And one of the things which was deliberated is on market making for ETFs. Even though there is an increase in trading volume in ETFs, still remains an important challenge for ETF in order to ensure liquidity on the exchange platform. The concept of market making comes into play. Market makers are appointed by AMCs, are responsible to put both buy and sell quotes in order to help investor exit or take fresh entry in ETFs. market makers gets compensated by of trading spread and also directly by exchanges and AMCs. The concept of less capital-intensive market making is being considered for ETF. A standard framework for market making will be considered and prescribed. In order to ensure liquidity on exchange platform, and one of the suggestions is to prescribe a particular threshold below which all transactions by the investors, except the market maker, has to be executed on exchange platform. Investors in general cannot approach AMCs in order to subscribe or redeem units in ETF. Investors only has the option to trade units of ETF on exchange even if it is at a loss as compared to NAV. In order to address this issue, concept of liquidity window is under consideration, wherein when the window opens, investors can directly approach the AMC for redemptions of units of ETFs without any exit load. And the committee has also, group has also suggested a lot of transparency. ETF and index funds are more transparent when compared to the actively managed funds. The portfolio of ETF index funds can easily be tracked by looking of index compositions along with the weightage. Any changes in portfolio can also be tracked by looking at index rebalancing. Further, in order to enhance transparency on NAV of exchange-traded funds, the requirement of indicative net asset value to be disclosed on exchange platform on continuous basis, subject to certain conditions, are under consideration. The indicative NAV is subject to certain indicative NAV provide the real-time reference of the portfolio of ETF, which may be defined as the per unit of NAV based on the current market value of its portfolio on the stock exchange during the trading hours. This may help the investors to take more informed decisions while trading on exchange platform. Introduction of the other development which has been proposed is introduction of ELSs in passive fund category in the form of index fund. This may help the greater penetration in small towns and cities. As you know, there is a special tax incentive for ELS schemes. In order to make ETF index funds cost effective, the mandatory deductions towards investor education's awareness from the scheme may be reduced from the existing 2 bips. This is one of the suggestions. And whether the cost of this market making, whether should be within the TR and all, this is also one of the discussion point. And I want to conclude with 3 suggestions. How to encourage or develop this passive industry. Investor education for all retail investors on the benefits of passive investments. All the stakeholders, including mutual fund exchanges, index companies, should focus on the same. I think this conference is also one of the way this passive awareness on the passive investments can be encouraged. Incentivizing the market makers and launch of liquidity enhancement schemes for improving liquidity to ETFs on the exchanges. Actually, earlier, Basic came out with some incentive schemes in encouraging some products in their platform. Similar thing can be thought of this also. And one of the other suggestions is that encouraging large investors to buy the ETF through the exchange rather than buying directly through the mutual funds. With this, I want to end. Thank you for listening.